In this chapter, we'll estimate the fair market value of the business, defined here as the amount at which property would change hands between a willing buyer and a willing seller when neither is acting under compulsion and when both have reasonable knowledge of the relevant facts. We'll use the asset, market, and income approach and focus on the cash flows of EBITDA, discretionary earnings, and net cash flow to invested capital. In the asset approach and the adjusted balance sheet method, we'll rely on the balance sheet to recognize net book value of the assets included in the transaction. In the market approach and the direct market data method, we'll rely on the projected income statement and the cost and income structure to develop the cash flows of EBITDA and discretionary earnings. In the income approach and the discounted net cash flow method, we'll use the projected cost and income structure to develop net cash flow to invested capital. Net cash flow to invested capital represents the cash available to investors of capital, that is, debt and equity owners, after the firm has met all operating needs and paid for investments in current and fixed assets to keep the company healthy in the projection period. The asset approach includes adjusting the balance sheet to recognize the net book value of assets included in the sale, assumed here to include inventory, equipment, and fixed assets, and exclude cash and accounts receivable. Since value is forward-looking, the cost and income structure was developed to reflect performance for the existing company in the projection period. The cash flows of EBITDA and discretionary earnings were developed. In the market approach, we started with the value measure, in this case EBITDA and discretionary earnings. Then we developed an indicated multiple by comparing the performance of the existing company to the performance of the comparable companies. Next, we applied the indicated multiple to the cash flow to yield an indicated value. Then, we assigned a confidence level to that value based on the amount of variation in the data. Last, we added the weighted values to get an indicated weighted value developed by the market approach. The income approach and the discounted net cash flow method relies on the same cost and income structure. We developed operating cash flows for each of the 5 years in the projection period. At the end of the projection period, we estimated the value of all future earnings. We call that the terminal year cash flow. Then, we developed net cash flows to invested capital. The income approach recognizes the magnitude and timing of cash flows and develops the present value of these future cash flows. These future cash flows are discounted by a rate that applies a level of perceived risk to the cash flows. The sum of the present value of each year's cash flow represents the estimated value. We used 5 years of data here because we assumed that revenue would not grow at a fixed rate in each year and growth would vary. We also assumed that costs and expenses were not all variable to sales. That is, we assumed some costs, like officer compensation and rent, were fixed and would change by a contracted amount. This level of detail will also be helpful when building the forecast business plan to show how management decisions can impact results. The values developed in each approach are weighted and aggregated to deliver an estimated value. For the cash buyer, we can place the projected return on invested capital in the context of direct market transactions and in a range of investments. In this chapter, we discuss the development of fair market value by using the asset, market, and income approach.